Hello everybody, my name is Bernicke and I'm going to be doing the May monthly market update, and I think this is a good time to discuss a variety of different things, but especially to go over some of the negative news out there. We haven't had a shortage of news talking about the debt ceiling being lifted. We haven't had a shortage of news regarding some of the bank failures. My guess is we're going to hear more bad news before it eventually does get better. I think eventually our politicians will come to terms with one another in lifting the debt ceiling. Usually that happens right before the final hour. In addition to that, I do expect more bank failures to be announced in future days, but I also believe that most of this really bad information has been priced into the current state of the stock market. So I think a lot of this has already been baked in, and we don't necessarily feel that things are going to get worse than what is already projected. So I don't want to minimize the seriousness of the situation, but a lot of this bad news has been baked into the market already, in our opinion, and I can illustrate why. So for over 20 years, there's been a survey on global fund managers, and basically what the survey does is it tries to get a depiction on how negative or positive they are about the current state of the stock market based on how overweight in stocks they are or how underweight in stocks they are. The more underweight they are in stocks, that would imply that they're pessimistic about the stock market going forward. And if you look at where we're at as of late, you can see the pessimism and the underweight that they have for stocks is as bad as it's been going all the way back to right around the worst point of the stock market following the great financial crisis in 2008 and 2009. So global fund managers are very underweight stocks today, very similar to how they were back in those very scary times in 2008. Now, if we elaborate on this, if we just look at the sentiment of these global fund managers, you can see that as of late, you can see the sentiment of the global fund managers is actually a little bit worse than what it was in the global financial crisis in 2008. So basically what this means is our money managers are very pessimistic and very negative. And for me, from just a common sense intuitive perspective, you would think, gosh, what should I do as a result of this? If they're negative, maybe I should reduce my position in stocks. And so I think that's a natural response. So one of the things we always like to do here is we always like to test our theories. If there's a lot of negativity with these very smart money managers, as it applies to stocks, you would think that the stocks would do poorly following the periods of heightened pessimism. So what we did is we looked at all of these different periods of time where the sentiment was at a very low point or pessimism was at a very high point. So these are the negative periods of time where it kind of troughed out. And then what we wanted to do is we wanted to see, what does the S&P 500 index do after each one of these different time periods? And so on average, if you look and see what the stock market did the following 6 months, 12 months, and 24 months as measured by the S&P 500, it was up on average 11.18% in the following 6 months following these very heightened scary times, up on average 19.33% in the following 12 months, and over 37.03% in the following 24 months. So it's almost exactly opposite of what you think should happen. From a financial advisor's perspective, looking back at history, I know that this doesn't play itself out all the time. There were periods where the stock market actually dropped during those heightened periods of concern of the global fund managers. But on average, the markets tend to do well. And a part of the reason I think that happens is because it's easier for stocks to do well when things go from really bad to not quite as bad. And right now, I think most of us are looking at what's going on in the world and would say, gosh, there's some scary stuff going on that could negatively impact stocks. So we don't need things to go from bad to good. We just need them to go from bad to not quite as bad. So what does this mean for you? Obviously, at Bernicke Wealth Management, we're keeping an eye on stocks, we're keeping an eye on bonds. At certain time periods, we're a little bit more offensive. Other times, we're a little bit more defensive. Right now, with stocks, we're a little bit more neutral. And with bonds, we've actually been a little bit more offensive after being defensive for quite some time. If you want us to elaborate on what our positions are or you have concerns, please give us a call, talk to me. Talk to your advisor. We'll do our best to put context to the situation that we're in right now. Otherwise, I hope this helps alleviate some of the concerns and puts into context what's going on in the markets today. Appreciate our time today and hope you have a great rest of your spring. Thank you.